Instead of investing in stocks and bonds, are you interested in alternative investments? In this presentation, I'll be going over 4 alternative ways to invest your money to financial freedom. Number 1, investing in a real estate. Rental properties are a powerful wealth builder because they grow in value in 3 ways. They typically appreciate in value over the long run, they harness the power of debt leverage, and they provide monthly income. Most years, the value of your property goes up and your mortgage goes down. Wealthy individuals have around 18% of their investment portfolios in properties. Fortunately, buying directly into a physical property isn't the only way to invest. You can participate in other ways, including real estate investment trusts, also known as REITs, and land banking. Let's start by looking at rental properties. Investing in rental property. You buy a property and rent it out to a tenant. Keep in mind that to make a rental property purchase successful, owners must find a bargain, paying no more than 80% of the home's value when factoring in purchase price, closing costs, and renovations. Ideally, the rent you collect will cover your monthly expenses like your mortgage, taxes, insurance, and maintenance. Then after you pay off your mortgage, you can enjoy the rent as profit. Or you may sell the property when the price has appreciated significantly. This all seems to make a rental property an ideal investment, but there are always challenges in owning rental properties. Unlike stocks and bonds, rental property requires you to devote time to maintaining your investment. When the toilet doesn't flush or the bathtub leaks, it's you who will get the phone call. When you invest in real estate investment trusts, a group of real estate professionals buy and manage real estate on your behalf. REITs allow people to invest in real estate without buying property directly. REITs behave like fixed income securities, and you can rely on REITs for income. However, the capital value of REITs can rise and fall along with cycles in the property market. Many investors turn to REITs as an alternative to savings and fixed deposit accounts. REITs offer 2 attractive benefits: liquidity and high dividend yield. But they have risk as well. Management risk. It is just one management team that makes all the decisions on buying, selling, managing, and operating the REIT properties. Interest rate risk. Higher interest rates mean that the cost of borrowing goes up and REITs will suffer from larger interest payments on mortgages. If you plan to keep a REIT for retirement, do a serious evaluation of the property sector as a whole every 3 to 5 years. Even if dividend yields remain strong, the capital value of investment can go down. Remember that an investment in REITs is first and foremost an investment in real estate. Land banking is a practice of purchasing raw land with the intent to hold on to it until it is profitable to sell it. The intended increase in value generally comes from the conversion of raw land to residential or commercial use, or from the potential for extraction of natural resources. Investors like the concept of land banking as it is a tangible asset as opposed to stocks and bonds. Before purchasing land, conduct due diligence on the area for population and economic growth. The most desirable parcels of land for land banking are those that lie directly in the growth path of developing cities. Some of the best-known land bankers are people like Donald Trump and the Rockefellers. Number 2, investing in precious metals. The idea behind investing in precious metals is that it protects your portfolio against inflation. The precious metal asset class, consisting of gold, silver, and platinum, is the only one with a negative correlation to other asset classes. What this means is that precious metals perform best during the years that traditional asset classes, consisting of stocks and bonds, have negative returns. Traditionally, investors have acquired these metals as a source of security in times of political unrest or economic uncertainty. So when the value of the dollar decreases, at least part of your portfolio will retain its value despite the deflation. Many opponents to precious metals as a solid investment have pointed out that while metals do hold their value over time, they don't earn much return. It offers no income, no dividend, no earnings. It is considered as store of value, an alternative to currency. And during economic collapse, survivors are going to be more interested in useful goods than in a soft metal. Thus, many investors suggest investing in real estate to hedge against inflation. But most proponents have argued that precious metals have substantial advantages. You can hold it in your hand. It's not just a certificate of value, but actual physical wealth. For many, that will never cease to be important. Transfer very easily. No third-party verification, no bank accounts, and no fees. It can literally be handed over. Established reliable value anywhere on the globe. Generally, any citizen in any country across the world will accept gold or silver as payment. No counterparty risk. This means that once you have physical gold in your possession, you don't depend on another party to fulfill a contract or keep a promise to retain its value. This is unlike stocks, bonds, and ETFs, as they require another party to fulfill their end of the deal. This explains why so many currencies over the centuries have been either minted from gold or silver. Number 3, investing in art and collectibles. We hear more and more these days about art and collectibles being auctioned for hundreds of thousands of dollars, or someone discovering that grandma's stamp collection in the storeroom is worth a fortune. There are collectibles worth a lot of money: fine art, wine, a few select baseball cards, and so on. The rule to remember, though, is that something has to be rare and desirable to be worth anything. A painting by an artist who turns out a new piece every week is far less valuable than something by, say, Vincent van Gogh, because there's relatively little left available from Van Gogh's time. For instance, expensive paintings seem to always take the spotlight when compared with other collectibles. Nude, green leaves, and bust by Pablo Picasso was sold for astonishing $106.5 million. You absolutely need to know what you're doing before you get into the art and collectible market. The value of art rises and falls sharply with the economy, and what's considered valuable to one collector could be worth far less on the open market. There are 3 challenges that you should keep in mind before investing in art and collectibles. 1. Low price transparency. Buying securities usually occur at fair market value in large marketplaces, but when buying a piece of art, it is much more difficult to confirm that a fair price is being paid. 2. Security. Investors are responsible for safekeeping of the collectible. If the piece gets damaged or lost, its value is compromised. 3. Liquidity. Securities can be sold much more easily than art and collectibles because securities are traded more readily on organized exchanges. With that being said, you should buy art and collectibles primarily because you like them. Their profit potential should be a secondary consideration. Number 4, investing in commodities. As you gain experience in investing, it makes sense to start looking at other asset classes. Investing in commodities takes some extra learning, but it can have some real benefits for your overall returns in your portfolio. What are commodities? Commodities are basic goods that can be substituted with other equivalent goods of the same variety. These include precious metals, such as gold and silver, energy, such as crude oil and natural gas, industrial metals, such as copper and tin, food products, including wheat and cattle. Commodity products become so homogeneous between the suppliers that though there may be slight differences in quality, the products mainly differentiate on price. Supply and demand are the main reason commodity prices change. When the weather is cold, demand for natural gas for heating purposes often makes price rise, while a warm spell during the winter months can depress prices. Investors break down commodities into two categories, hard and soft. Hard commodities require mining or drilling to find metals like gold, copper, and aluminum, and energy products like crude oil, natural gas, and unleaded gasoline. Soft commodities refer to things that are grown or ranched, including corn, wheat, soybeans, and cattle. The biggest challenge with commodities is that they are physical goods. There are 4 ways to invest in commodities. 1. Investing directly in the commodity. 2. Using commodity futures contracts to invest. 3. Buying shares of exchange-traded funds that specialize in commodities. 4. Buying shares of stock in companies that produce commodities. Advantages of commodity investment. Commodities can deliver high returns. They can protect against periods of high inflation. They can provide diversification within a portfolio. And due to the world's limited resources and continued emerging markets growth, there may be a sharp future rise in the price of most commodities. Disadvantages of commodity investment. Commodities are very high risk as they can fall very sharply in value. They are closely correlated to global economic growth and so may fall sharply in value during global economic slowdowns. And since commodity investments are normally made via futures, the return is not simply related to the current market price of the commodity. Commodities offer a unique way to invest in assets other than stocks. Though prices can be relatively stable for long periods of time, commodities can be influenced by natural events and supply disruptions. In my last presentation, I went over 4 ways of making money in intangible investments, such as stocks. If you want to move away from intangibles and start investing in tangible properties, I hope this video helps in reaching your financial freedom. If you like this video, please subscribe and give me a thumbs up.